Thanks everyone for attending. And we've got a good one today. I think it's relevant to all our practice areas, whether we're tax professionals or trust and estates professionals. It's really relevant in today's environment with a lot of people working remotely and possibly moving out of the state, some retiring, and just beneficiaries living out of the state. So, as a result, wanting to shed their California resident trust status. And we've got someone who's an expert in this area who knows the ins and outs of the issues that might come up. His name is Peter Myers. He's a certified specialist in estate planning, licensed in both California and Nevada. So I'll turn it over to Peter.
Thank you, Jay, and thank you, Anne, for the intro on what exactly the title is. And I explained in the beginning, I use extraterritorial trust because sometimes I'm teaching for one of my, I've got South Dakota trust companies, Delaware trust companies, Alaska trust companies, as well as Nevada trust companies who are clients. And so I just have like a generic extraterritorial trust. Extraterritorial meaning outside of California. Now, as we all know, the root of territorial is terra, meaning earth. So would it be a Martian trust? And as far as I know, nobody's licensed on Mars yet. So that would be an interesting presentation and probably appropriate for a Friday night or a Saturday morning with my friends waltzing through the woods. Let's head off into the disclaimer, and I'm talking about strategies that are within the law. I'm not your lawyer, blah blah blah, but within the law. This is not tax evasion. Tax evasion is a crime. This is coming to learn what the law is, and the FTB gives us a roadmap. So does the legislature. But where does this come from? This, where are these clients coming from? They're coming from AOC. They're coming from this phenomenon on the, primarily Democratic side of the political spectrum, where we're not taxing rich people enough. And so we have to come up with ways to tax the rich more. And even though California hasn't changed its income tax for years, it's now like all of a sudden people are waking up and saying, oh my God, the income tax here is really high. I guess they're watching Fox News or whatever, but they're coming to us and they're saying, I'm leaving California. So we've got, this is what I call the departing California resident. And so this is part one. This is going to be a client. You're going to see an out-migration client. It's very significant. California, for the first time in the census history, has actually lost population. There have been threats by others, even to the left of AOC, up to 16.8% income tax. That was Santiago. It died in committee, so we don't have to worry about that one. There's also a wealth tax being spun around. There's efforts to make outside consultants unitary businesses. It's really, it keeps us employed. I'll put it that way. So if certain individuals are leaving California and they have employment related contracts, all right, there's a rule, there's a safe harbor there. So they're going to leave California and they're going to have an employment contract back with their California employer. If the contract gives them 546 consecutive days outside of the state, you actually safe harbor off into a non-resident status, assuming you also, move outside the state and so on. Now, to move outside the state, the FTB gives us a roadmap. And occasionally people hire me and they say, I need your help in moving out of California. And my answer is always, not, you probably don't, but I'm certainly available to work with you in a checklist and to begin to set up your structures in Nevada. Because the FTB publication is really clear. the franchise tax board tells you what you need to do to stop being a California resident. And you just have to pull up this publication, 1031, easy to remember, right? 1031 exchange. But it's a totally different concept. And so it's a facts and circumstances test with no safe harbor for being a non-resident, except for the one I mentioned previously, the employment contract for the consecutive 546 days outside the state. So we look at all these factors. Where is your spouse? Are your children going to public school? You know, that's like a deal killer. If your children are going to public school in California, you're a California resident because you're taking advantage of the California tax system. Meaning, you know, K through 12. I mean, if they're going to UC and you're in Nevada, maybe you get an argument there. You want to change driver's license, vehicle registration, professional licenses. You know, I do have clients who are CPAs, lawyers, insurance agents, architects, engineers, etc. And you want to be licensed in at least one other state to be able to say that you've left California officially. Register to vote in that state, open up bank accounts there, create social ties, health club memberships, real property, blah, blah, blah. Now, what about a trust? And this is where, you know, we estate planners get involved. Can I just set up a Nevada trust and be outside, create a non-resident? And the answer is maybe. I mean, that's what this presentation is about. If it's a grantor trust, you know, what do you care? You know, you could create a non-resident grantor trust, but it's still going to be taxed back to the grantor who is a resident of California, assuming they are. But a non-resident trust and a non-grantor trust is going to look at these three factors. Where does the trustee reside? Where does the beneficiary reside? And in other states, except for California, where does the grantor reside? And so here's your state chart. And this is why I'm busy. So it goes through the different factors, states with no income tax on trusts. So these are the ones down in the bottom right-hand corner that everybody's trying to angle for. We have an office in Washington. I have clients in Washington state. That's fine. We can set up our non-grantor trust right there in their home state. And we don't have to go to Nevada. You know, Nevada's got a better rule against perpetuities, better asset protection, blah, blah, blah. But, you know, we could stay there. Note that the grantor domicile, this is where the grantor is resided. California is not on that list, right? So you can have the grantor in California set up the administration elsewhere, have beneficiaries elsewhere, and you may be able to create a non-grantor trust outside of California. And this is my cautionary tale. So when don't even think about it. So I've got the, you know, we all run into this client that's like, you know, I'm going to make a lot of money and I want to scam the state. No, it's not going to work. Don't see a lawyer. You know, I can't counsel you to evade taxes. That's, you know, I lose my license. So, you know, I'm the wrong person to talk to, and I don't know anybody to refer you to. So that's, you're off my prospective client list. This is for legit people. Now, you don't even think about it if the taxpayer, that's TP stands for taxpayers, or if the taxpayer's beneficiaries, if they're establishing a trust, live here and plan to do so indefinitely. So this is, it's kind of a reminder for estate planners doing middle-class estate plans. If the kids are going to school at UW, which is University of Washington in Seattle or thereabouts, or University of Oregon, which is in Eugene, or Oregon State, which is in Corvallis, they may be non-residents at some point in time. And why are you setting up your trust in California and deliberately subjecting your Washington State beneficiary to California income tax by putting the trustee here? That's where you need to think a little more creatively. I need to think about trustees outside of California. And your client is always saying, yeah, but I want to control them. Okay. You explain to them the concept of a directed trustee, where you have somebody directing the trustee and who's outside of California. But don't even think about it. If the kids go to school here, all the beneficiaries are here, everybody works here. Or there are creditor issues because under the UVTA, you can void the transfer of a gift by gift to a zero tax state under the UVTA, which stands for Uniform Voidable Transfers Act. It used to be called the Uniform Fraudulent Conveyances Act. But basically, it says when you do a gift without consideration and render yourself insolvent, it can be set aside. It's voidable. So if you've got a client with creditor issues already, I mean, not just prospective future creditors, they're not a good candidate for this kind of planning. So when they're leaving, you're going to put together a checklist, something like this, and you're going to give it to the client. Maybe you monitor them, maybe you don't. I mean, it sort of depends on the client's desire to pay you. Some clients want you to do all the work. Some clients want to do all the work themselves and complain about your bill. And so if they want you to do all the work, you're going to create this checklist. And, those are the clients, obviously, we want to work with because they're not going to complain about the bill. So now there's an audience participation moment. I'm going to open my chat box. You have a client who comes in, they're, making, let's pick a number, $500,000 a year doing whatever professional practice, business, real estate, pick the, your typical higher income type client. I'm thinking about leaving California. They come into you and they ask that question. I've got my chat box open. I'm waiting for people to punch in. What else? What do you want to know about that client? I mean, obviously net worth, income, but let's assume, let's give them 10 million in net worth. Let's give them 500,000 a year in income. And what other questions are we going to ask? I can see the audience is asleep, having lunch. It's one of those. When this is live, it's much better because I'm walking down the aisle with a microphone and I can just call on you, and then you're stuck having to say something in the microphone. Okay, so what do we want to know? What are the questions I ask? Well, when and what does thinking about mean? So, client-centric practice. We've all evolved from the docu-centric, one size fits all. Come on in, I just figured out how to use my word processor and I can generate a trust in 5 minutes. We've all evolved from that. That was 1993 planning. So if you're still doing that, I would say you're in trouble, or you're lucky, because you can't do that anymore. They want counseling and they want you to ask questions, and that's what they're paying for. They're not paying for the document anymore. The documents are free. That's what I tell them. The documents are free. You're paying for my advice in connection with the document. What does thinking about mean? When are you thinking about moving? And to which state? To which state? Because if they're just going to Hawaii, New Jersey, or New York, you're going from the frying pan to the fire. Or you're just substituting 13.3 for 9.5 or 11.2, or you're not really saving anything. Now, if they're going to Florida, Texas, Washington, know the states that have zero income tax, and so know whether this is going to be important. Nevada, no personal income tax. So that's why I'm licensed in Nevada, and this presentation is about Nevada. Then other questions you want to know, as Jay points out in the text, in the chat, the source of income, California source, that's the bottom one here, is it passive or active? Passive meaning, you're just sitting on your investments and they're generating income. Active meaning you're managing whatever it is that's creating that, like a business. And then if it's a business in California, you're going to have California source income. So you got to drill into that. Who do you want to control the wealth? If it's just marketable securities, retirement plan, blah, 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 I'm going to move to Las Vegas and my kids are going to inherit this and they're all going to Arizona, or you're going to Arizona and the kids are going to Las Vegas, whatever. Arizona is a common place where a lot of my clients go. It's there is a personal income tax there, 2 or 3%, not super huge, but lower than California, but not zero. So you may have some Arizona bound clients and you'll be able to counsel them through that. It's a progressive tax similar to California. It just doesn't go up as high. So I'm going to have Bob, and I'm going to move Bob to Arizona because this is a real client, more or less. It's kind of an amalgam. of several clients. So he's CEO, majority shareholder of ABC Widgets, California C Corp. He's planning to move to Arizona. He's planning to sell his stock soon, but there's no enforceable contract in place, no term sheet, etc. So other points of consideration, what he's coming to us for is how to structure the sale of his company, because part of what the buyer is going to want is an earnout or deferred compensation, meaning, you have money in escrow and you don't get the rest of it until we make sure the business is really worth what we think we're paying for it. And so they call it an earnout. So you to stick around for 2 years and make it, we're covenant not to compete. They don't want Bob to go to Arizona and turn around and create a new company in California and start competing with the one he just sold. And he's interested in consulting income as well as part of that package. And then, of course, there's the stock price, right? So you have to know this. So you're going to structure the sale of your departing resident, and you're going to need to know like what California taxes and what they don't. And this little chart, which will be in your materials, lays out what's taxed and what isn't. So real property in California, that's always going to have a California source. So you've got the apartment buildings in LA and Contra Costa County. You're not getting away from California. You're paying California income tax on that. If the real property is outside California and you're a non-resident, that's non-taxable. So to the extent they've 1031 exchanged into, Walmarts in Georgia and Florida and South Carolina, all, what our higher net worth clients are doing, they're getting out of California. All of a sudden, that 13.3% tax on the margin above $1 million in income, or the 9.3 on the margin above 460 or so, that goes away and is non-taxable on those non-California assets. Tangible personal property in California, so the business equipment, you bought the olive pressing mill that's pressing olives into olive oil, the brewery, the winery, all taxable back to California. We've got clients who are, trying to move out of California, but your winery is in Napa Valley, so you have California source income. I can't help you with that. Now, as you sell the winery and you get marketable securities, that you reinvest in exchange for the winery interest that you've sold, yes, we can move those marketable securities outside of California because they're not California source. You're just getting dividends off a C Corp. And that's intangible personal property. Let's see if I have that down here. Or other intangibles. I do. Down here, the second to the last line is the gain on the sale of a partnership interest, or the interest on the dividends and interest on stock, corporate stock. That's not California source income. Now, if you're a California resident, you're paying California tax on that. But if you've moved to Nevada, all of a sudden the dividend income and the interest income goes away, and maybe some of the consulting income. Now, I say maybe some of the consulting income because you'll see this middle row here. We used to think, in the SALT world, the state and local tax world, used to think, you move outside of California, you sell your goods back to your California employer, the person who hired you as a consultant. We used to think, okay, that's clearly not California source because you're performing those services in Arizona until Bentley. And then Bentley comes along. And, now we're struggling with this. And Bentley analyzes whether this guy who is doing screenplays in Arizona, so Arizona on this one, and he's selling them back to an LLC and, San Fernando Valley probably, or, somewhere in the Hollywood world. I don't know whether they were G-rated or X-rated, but somewhere between Orange County and Ventura County. And he's selling screenplays back to this company. And they go in and they say, you have a unitary business and you're only doing business in California. You're within and without California. Now, we thought before Bentley that was just consulting, but he's doing business in California. He has clients and customers in California on this business of screenwriting. And so Bindley says you're 100% taxable to California's California source income, not appealed because, or it was appealed this far, but it was like $700 in tax. And so all of us are kind of scratching our heads out here in the salt world saying, if a little more money was at stake, we might know what the real answer was. But for $700, nobody's going to appeal that on up the ladder. All right, so am I going to talk about names? So this is what Jay asked me. Are you going to talk about names? No. All right, a little bit because names are somewhat germane to what we're talking about here. It's where somebody wants to stay in California and they want to get their trust outside of California with an incomplete gift, meaning they want to reserve the right to become a beneficiary later on. And the IRS 2.5, 3 years ago is no longer issuing PLRs on these or spousal limited access non-grantor trust slants. So what's a slant? A slant is a slat, which you all know. Maybe you don't know slats, but a slat is where we're taking advantage of the current $12 million per person that we have until 2025, and we're getting $24 million outside the estate by getting husband and wife to split the community property into 2 separate property pieces, and then making gifts to 2 trusts, completing the gifts, closing out their $24 million before the sword of Damocles drops on them in 2026 and reverts back to a $6 million exclusion. Well, normally those are going to be grantor trusts. So you think, oh, well, I'm going to be really clever. I'm going to set this up in Nevada so that slat is now not taxable in California. And the answer is no, that doesn't work. That's a grantor trust under 677A1 because the spouse can get the income. Typically, you're going to set up a slat where the spouse could get the income on a discretionary HEMS basis, health, education, maintenance, and support, discretionary principal and income, distribution trustee to decide that. If you insert an adverse party, meaning a remainder beneficiary, a child, for example, and you have a guardian for them who's outside the state, and their consent is required for a distribution of income to the spouse, you've got yourself outside of 677A1. And we've created a non-grantor trust. Now, we don't do it with one child for the same reason. So NINGs are relevant because we look at the IRS's rationale on the PLRs and NINGs. And the IRS's rationale as well, you got a committee of 3 people on this distribution committee. So you don't have a taxable gift back from the adverse party to the spouse. So if you had just one child and the child's consent is required, there's an argument the IRS has that child's consent to the distribution of income to this other spouse, to the beneficiary spouse, the mom typically, is a taxable gift from the child to the mom. So the IRS says you set up a committee of at least 3 people, then none of them are making a taxable gift if it's a majority rule with these veto powers and so on. So you structure slats similar to NINGs, but you complete the gift. You don't do an incomplete gift because that's what's going to get attacked. And then once you complete the gift, Kestner comes into play, and you've got this Supreme Court authority about California's ability to reach their arm into Las Vegas and pull money out of the bank there. Other even easier things to do are your dynasty trusts. Nevada has a 365-year rule against perpetuity, so you can set up a dynasty trust there. We always say, oh, we're going to set up an IDGIT dynasty trust, an intentionally defective grantor trust. Well, that's if you want to move a lot of assets outside the estate. It's not an income tax play. If you want an income tax play with a dynasty trust, you set it up as a non-grantor trust. And then you have to structure it so that no trustee is in California and no mandatory beneficiaries in California, non-discretionary is how they call it. So no trustee, no beneficiary, no California source income. Now there could be California source income, and then you're filing a 541 NR, which is the California trust income tax return for a non-resident trust for the California source income. So you may end up filing some kind of source income, but you're limiting the California tax to the California source income, and the dividends and interest from the marketable securities portfolio are outside of that. You've avoided the 13.3% on that if you've got the $1 million a year income client. And then I get questions. I have 7 that I work with. I'm missing one here. I don't know why, but I wrote down 6. The client says, okay, so I've got to hire a Nevada trustee to do this. Yes, you do. Well, how do I trust them? Well, here are the 6 I work with. Here are the 7 I work with. And here are their phone numbers. So for those of you who are considering practicing in this area, I would encourage you or implore you, or even if you're not considering practicing in this area and the kids are out of state, the kids have already moved to Texas and Florida and Washington, why are you sourcing it to California? Why are you putting your trustee in California? So you're going to have to get to know some Nevada trustees. These are the 6 directed trustees I work with in Nevada. I gave you their phone numbers. Have a little write-off, grab your camper van and drive to Reno and head down 395 to Las Vegas and visit all of these trust companies so you can meet the individual trust officers and you know who you're dealing with. They got a KYC, you got a KYT. You got to know your trust company. And so this is my list that I work off of. You can see about 4 of them are in Las Vegas. About, 3 of them are in either Reno or Dayton. And one of you is texting me. I don't know what you're saying. You're giving me a picture. Thank you. Okay. I appreciate that. I appreciate the humor. Okay. Trust. You have to know a little bit about trust income tax to be able to explain this to a client. And so this is a little digression into trust income tax. If you have not taken a class in trust income tax, you probably should audit one at the community college, or look at a Spidell webinar or a series of webinars or somebody to teach you a little bit about trust income tax, because it's important when you're planning to know kind of how this is going to shake out in the future. And how it works when you put in a discretionary standard of health, education, maintenance as principal and income for health, education, maintenance, and support. How is that income taxed? Well, the trust gets a deduction at its level for the income distribution to the client, right? Assuming it's a non-grantor trust. If it's a grantor trust, it's all taxed back to the grantor. That's easy. Non-grantor trust, you've created this other thing. Well, what is income? And so then you have to know the difference between fiduciary accounting income and taxable income, which may be different things. Fiduciary accounting income is based on state law, and that's income from assets. And taxable income is based on federal tax law, typically, or California tax law. So you might have muni bonds, for example, creating fiduciary accounting income, but that's not taxable income because muni bond interest is tax exempt. You might have you might have taxable income like capital gain, but it's not fiduciary accounting income because the trust defines capital gain as a return of principal. So you got to know your Uniform Principal and Income Act. So there's a little bit of complexity in this to be able to counsel clients through how this shakes out after they die and their kids are starting to get principal and income distributions from their Nevada trust or even their California, Washington, Texas trust, whatever. You also have to know the distinction between a simple trust and a complex trust. Simple trust, all income. So the easiest way to think of that is a Q-tip, all income to surviving spouse. That's a simple trust, easy to remember. Complex trust, bypass, discretionary. Income can be accumulated at the discretion of the trustee. DNI is the income that has to be distributed out under fiduciary accounting principles. So non-grantor trusts can change from simple trust to complex trust. They could be either a conduit where they're like a simple trust, they're taking the income, passing it through, or they can be a true taxpayer accumulating the income. And when we do Nevada trust, we always want them to be true taxpayers because we want to be able to accumulate that income in Nevada so that the income is not just distributed out to the California beneficiary and thus taxable back to California anyway, because the beneficiary is a California resident. So in a simple situation, we have sample non-grantor trust. It's either taxed here at the trust level, or if it's distributed, it's deducted at the trust level and taxed here at the beneficiary level. And they're my phantom 20-somethings getting the distributable net income. If the non-grantor trust accumulates income for future distribution, so it's a complex trust, it itself is liable for the payment of income tax. So you're thinking, okay, it's liable at these rates. So federal rates are higher. So this is where you have to put together spreadsheets and algorithms and get really complicated because you're gonna be at 37% federal above 13,000 in income. Now that's income, meaning dividends and interest, not capital gain. So understand, federal gives you a benefit for capital gain, 23.8%, 20% plus the 3.8 net. So it's 23.8%. So you're way down here, under 24%. With any kind of capital gain, even 10 million in capital gain, you're only at 23.8%. So this is an important principle, because that stock, that intangible personal property that the client has, that's he bought for $500 as a founder, and it's now worth 10 million, moves it to a Nevada trust. That $10 million capital gain is only taxed at 23.8%, unless it's excluded from tax as QSBS, or it falls into some other exception, or you've created a CRT, or you guys have done some extraordinary planning to mitigate that. But California has no similar benefit for capital gain. So that $10 million is taxed way up here at 13.3% because it's over $1 million. We don't favor capital gain over dividends and interest and other ordinary income here in California. So clients look at this and they say, so wait a minute, I got my $10 million gain, I'm going to get taxed 23.8% plus 13.3%, and the state is not deductible from the federal. So I'm getting taxed at 37.1% on my $10 million gain. Yes, you are. $3.71 million is going to one or the other government. This is why I have a job, because we can mitigate that. We can defer it. We can look at QSBS. We can look at moving part of it outside the state, so long as they're willing to complete the gift. I don't like nings. I know some of you will say, well, just put it in a ning. Yeah, I don't like nings. Here's the tax on capital gain. It's a little trickier than that, because sometimes you have business owners who sell property and you've got some recapture of different kinds of depreciation. So you got to know what kind of capital asset it is. And so my accountant students out there have required me to put in these bottom three rows, but those of us who are mere lawyers just think of it as 23.8%. A non-grantor trust can be situs outside California. So most advisors form this in a state which does not tax the income earned by trust. And that was my prior slide. So you establish situs in that trust, use a trustee that's a resident of that state, ideally holding some property in that state. There's a condo in Las Vegas, there's a mobile home in Henderson, there's a whatever, or a bank account in a Nevada bank. And then that company holds the stock certificates and bank accounts. They're intangible personal property, generally deemed situs where the account holder or shareholder resides. Now, what if you say, okay, well, yeah, my client is fine with that, but they don't want to relinquish distribution or investment control. Well, if your client is going to be the investment and distribution trustee and simply make the Nevada fiduciary, the Nevada directed trustee, a directed trustee, you've got 2/3 of the income back into California, because you got three trustees, 2 are in California, one is in Nevada. It's a very simple, fraction. 2 divided by 3 equals 2/3. So 2/3 of the income is going to get taxed back to California. So you say, well, how do I get out of this? You have to have the distribution and the investment trustees outside California. And you have to have contingent beneficiaries. So, so step 1 is make sure there's no California resident fiduciary, meaning trustee. Step 2 is make sure that the mandatory income beneficiaries are not in California, because mandatory income is going to put that beneficiary's income into California. And third, make sure it has no California source income. You can't do this with the apartments in Van Nuys. Sorry, that's California source income. You're always paying California income tax on that. You can't move real estate to Nevada, at least that I've seen. And we talk about extraterritorial. Can we move it to Mars? I don't know. Maybe Elon Musk will figure that out. But notably, unlike New York and New Jersey and some other states, the settler's residence is irrelevant. So California's tried to, the FTB introduced a legislative proposal C, saying, well, this isn't fair. We're not collecting enough. 90 billion surplus is not enough. So we need more. And I'll get to that at the end of the slideshow about, sort of the struggles between this idea that rich people haven't earned their money. They accidentally, it's all luck. And since they won it gambling, we get 13.3%, you know, you know, the mindset versus, you know, the other extreme, which is like, the government should have nothing to do with the income we make and we should be taxed at zero. You know, I'm neither extreme, so I don't want to mislead you. I'm like just a rational guy saying we should have rational taxes, tax rates, you know, that incent people to go out and work, that don't unduly benefit people who are already very wealthy. But the reality is we have the system that we got and we're stuck with that. And that's our job now, to counsel clients how to deal with the system that we got. So if the income is accumulated, so we set up our slant. Let's call it a slant because spousal limited not access non-grantor trust. And I'm losing my voice. And we want to move some of the capital gain back to the spouse. There's a throwback rule in California. So if you move the Nevada, some of the Nevada capital gain, you get your $10 million sale, and then you say, okay, I'm going to wait a period of time, and then I'm $5 million back into the spouse beneficiary. You're just deferring tax because there's a throwback rule that goes, then when you do that distribution of capital gain, you tax the trust income average back 5 years. It helps, you defer the tax. What I explain to clients and what you should explain to clients is that you never have a slant make a distribution like of capital gain in particular to the spouse. And they say, but we want a condo in Hawaii. Here's the answer. Have the non-grantor trust buy the condo. So a Nevada trust owns a condo in Hawaii. How does California tax that? They don't, okay? You can control the investment trustee and you can control the investments that are made. You want your condo in Hawaii? Have the trust buy the condo. Don't distribute it to the, well, I want it in my name. No, you don't want anything in your name. If it's in your name, it's subject to tax, creditors, all sorts of problems. Keep it out of your name. Put it in a trust that you control. Clients don't get that. So I empathize and sympathize with all of you who have clients who are still at the 100 level course. They're freshmen in estate planning, and they think everything's got to be in their name. They won't even fund a revocable trust. It's like, I can't help you. It's like, go to one of Peter's programs. Okay, what is C Corp of a, what is the situs of C Corp of a California corporation? And that's going to be, and it depends. There's this thing called qualified income investment securities. That's drilling into the weeds that you want to look at if you have a California C Corp and you want to move that outside Nevada. Look at qualified investment securities and see if it's exempt. Multiple trustees, you've got the proportional rule. I talked about this. Same thing with multiple mandatory income beneficiaries. Let me see if I have any more chats. I don't. Good. So if distributions are subject to the trustee's discretion, then they're contingent beneficiaries, right? And the trust is not subject to, the trust in Nevada is not subject to California income tax on non-California source income. Once that income is distributed back to the California beneficiary is going to be paying income tax. And the trust, if you're distributing capital gain back, is going to be subject to that 5-year throwback. So once again, you know, you have to explain to the client, don't move stuff back into your name. The whole purpose of getting it outside your estate and getting it outside your name is that you no longer own, you control. Control is better than ownership. Ask anybody, any debtor in bankruptcy, which is better, ownership or control? They will tell you control. And then if in a later year, so you've got a beneficiaries in high school now and they're applying to Harvard. Well, you know, Massachusetts is not exactly a low tax state, but you know, let's say they're applying to, you know, give me a state with a good university, you know, to UW. Okay, UW, Washington State, no income tax. They become a Washington resident. That beneficiary moves to a non-tax jurisdiction. Now, what if the trustee distributes to that beneficiary? And, you know, this is where my fellow SALT tax practitioners, the Ed Antolins of the world, who's fantastic, who could do this presentation in his sleep, says, you know, they might analogize it over to the 546-day rule that we talked about in the beginning with the consulting income. And so if they're outside the state for 546 days, we think that a distribution of income from the Nevada trust to the Washington state beneficiary is probably going to slip within that safe harbor. I talked about slants a little bit. So normally it's a grantor trust, and here's why, and then how you set up the adverse party and so on, and make it, put your slant in Nevada. So you got the family, husband and wife, 24 million. They want to set up a Nevada trust defer capital gain on their intangible personal property. You could pull this off. You could pull this off. You know, you got to watch all the usual stuff when you set up slats, right? The reciprocal trust doctrine. So you can't just go, okay, husband's going to give everything to a trust for the benefit of wife. Wife's going to give everything to a trust for the benefit of husband. They're identical. Ta-da! No, they have to be different. And so you have to counsel clients through this. Well, we have 2 kids. All right, that helps. So trust for the primary benefit of wife and child 1. Wife sets up a trust primarily for the benefit of child 2, husband as secondary beneficiary, because she's going to outlive him, right? We all know that. And have a power of appointment that's different in one than another. So this one's going to be GST exempt, and this one isn't, because they're going to put a general power of appointment over in daughter, no power of appointment over in son, because we know he's subject to leave everything to the woman at the bar with a snake, right? So we make sure that the trusts are different enough. Maybe we use different trustees. Maybe we use different assets. And so there's a list that you could probably get a whole separate program on how to avoid the mutual trust or the reciprocal trust doctrine. We could have one and talk about the ways that lawyers are making their trusts different. Set up one in Nevada and one in South Dakota, one in Nevada, one in Alaska, one in Nevada, one in Delaware. Different trustees. Like I say, different assets. You know, and you go ahead and you make one maybe grantor trust for a while, and then you toggle it off. You make it you put the house in it and make it a grantor trust, because the house is in California anyway. You get California source income, so what? And then you toggle it off after the house is sold, and you turn it into a non-grantor trust. So by definition, they're dissimilar because one's a grantor, one's a non-grantor, and you've got this toggle power and a trust protector. So this is where your lawyering and your creativity as an experienced lawyer in this area really matters. And this is where, you know, frankly, I get brought in, not to steal your client, but to be your co-counsel and work behind the scenes to figure out how to tease these 2 trusts out of each other, these assets away from each other, avoid the reciprocal trust doctrine, make sure you're not practicing the unauthorized practice of law in Nevada, and set it up for a structure for the income tax planning, as well as the estate tax planning. So I'm going to wrap it up with a couple of slides here and then take questions. These last couple of slides are just about, you know, what's going on with the body politic. And, you know, this is the body politic here. And we had this scare, I don't know if you remember, last year, AB 310, and this died in committee, thankfully. But the concept here was, you know, to take all these people moving outside of California and claw back their income. So, you know, they think they're safe in Austin or Las Vegas or wherever. And California was going to take the position that, well, you know, they were here a couple of years ago, so we're going to claw back their income. Thankfully, this one died. And I don't know that this would pass. The Privileges and Immunities Clause that comes to mind, you know, obviously Kastner comes to mind. It's obviously interfering with interstate commerce because it's disincenting Californians to leave the state. And then we had this other one that popped up with the Ing tax. And, you know, some of you are skittish and they're saying, oh, I don't want to do that Nevada stuff because it sounds abusive. And I know that the legislature's proposed, but the legislature is after our Ings, our non-grantor, our incomplete gift trusts. And this was the FTB's proposal that they presented to the legislature. This also died in committee, so this didn't go anywhere. But the idea here is they were going to amend these RNTC code sections so as to California source income, the nings and the dings and the wings and the kings, the different states, incomplete gift trust. But note, this legislative proposal C only was applied or to be applied to the incomplete gift, the ing, and everything I've talked about in this presentation has completed the gift. So you do a slant, you go ahead and complete the, how many of our clients are worth more than 24 million? Well, if you work at my firm, more than a few, but most of my clients are not worth more than 24 million. Most of my revenue comes from clients worth more than 24 million, but most of my clients are not worth 24 million. And so you can do completed gifts between the spouses and get the accumulated capital gain and income outside of California by using a slant, by using a slat with a non-grantor trust, by positioning in an adverse party, meaning a remainder beneficiary whose consent is required for a distribution of income to the beneficiary spouse. So that's all I got. That's slide 35 of 35, and we have 9 minutes to go to take any questions. If we don't have any questions, we've met the 50-minute limit for your 1 hour credit. I see no questions. Feel free to shoot me a question. I'll pause. I think I put you all to sleep. I think that's what happened here. Okay, good. Yeah, okay, good question. So do you risk the adverse party not approving to the distribution? Yes, you do. So is the adverse party a natural object of the surviving spouse or the beneficiary spouse's bounty? Usually the answer is yes. Okay, so usually the child is a remainder beneficiary and the parents have not divested themselves of everything. So they have 24 million off in the slants and they have another 20 million in their revocable trust. Revocable meaning they can change the beneficiary. So a child refuses to consent to a distribution of income to mom. Mom and dad can change the RLT and disinherit that child. So there's a little bit of suasion there. Where else do I do this? Sometimes the adverse person is a parent or a brother or a sibling, and everybody's part of this same cabal. And the cabal is a high net worth family. And if they know what's good for them, they consent to the distribution. But yes, there is a risk that the adverse person will not consent to the distribution. You can have estrangement between parents and children. It happens. A lot of my clients, it happens. And I have a psychologist I work with, Josh Coleman, in Berkeley. If you know him, he specializes in estrangement. So I send the parents typically to Josh to deal with it because you have a lot of psychological overlay. And they want to disinherit the child. And it's like, well, let's talk about that before we, go down that path, and let's get you psychologically, to understand what that message you're sending is. And then, so they work with Josh and I together, and then I do the planning and he does the psychology part. But yes, that is a risk that you have a remainder beneficiary that will not consent. So you got to make sure your remainder beneficiary is somebody that you trust long-term. And like I say, I typically have, other family members as remainder beneficiaries. You got to watch out. There is this, nobody's heard of it, but 2037, believe it or not, there's a code section after 2036 called 2037. And if the remainder beneficiary has less than a 5% chance of surviving the income beneficiary actuarially, then they're not counted. So you got to watch out for that. So if you put in just one parent, for example, as the remainder beneficiary, they actuarially are probably not going to survive their daughter. So you got to watch for 2037 in that situation. So you need another, you generally want a committee of 3 anyway. And most committees of 3 are going to exceed the 5% test. Now it's possible that you have, 300-year-olds or 95-year-olds that, you're going to have about a 2% chance that they'll survive. It's going to be the mortality of the surviving spouse that drives the bus on that. But just be alert. Oh, there's this 2037. What? 2030? I've never heard of that before. Well, believe it or not, there's a 2037 out there that you may run into with this remainder beneficiary being somebody who's a little too old. So ideally, it's the kids, the siblings, and then some amalgam of the parents and the kids and siblings, because the more the merrier. The more you have, the actual life expectancy of their survival gets above 5%. All right, I think you've all done a fantastic job. Oh, toggle, okay. Do you normally make your toggle provision from grantor to non-grantor a one-time event and not electable back and forth between years? No, normally I make it electable back. If I'm gonna toggle, I'm going to be able to toggle back and forth. What I usually do is I say you can't toggle back and forth within the same year. You know, that's abusive, I think. You can't toggle. I'm going to toggle it to non-grantor trust right as I sell the asset, and then toggle it back to grantor trust when it's kicking out, you know, tax exempt income. No, I think that's abusive. I think one calendar year, 2022, you want to toggle it to non-grantor. You cannot toggle it back to grantor until 2023. That's, you know, I like that. You know, why is that a gut? Is there a PLR? What am I relying on? Revenue ruling? I'm relying on my gut saying that's abusive, to try to be able to toggle it back and forth within the same year. But I do have toggle provisions that allow it to toggle back. The issue with toggling it back, though, is now just the trust protector, because oftentimes you're toggling it back with, you know, something that possibly could create an inclusion issue. And so as a trust protector who's doing the toggling, you know, exercising some kind of general power of appointment, or are they making a taxable gift, or are they, you know, you do get into some really tricky issues. And now if it's the provision to simply substitute assets of equivalent value, you know, most people think, okay, well, that's not an includable, you know, that sounds like it's equivalent value. There's a fiduciary duty, you got to substitute assets of equal value. So maybe that power, but what about the power to add a beneficiary? If you toggle that back, then I think the trust protectors do adding a beneficiary. I think the trust protector is exercising some kind of power of appointment there. So when I toggle it back to grantor trust status, I do not toggle it back with the add a beneficiary provision. You know, that it makes it a grantor trust if the trust protector has the power to add a beneficiary. So I eliminate that one from the toggle back, Doug. So it's usually the substitution power that I'm going to use, because I feel that's the safest from an inclusion perspective. Any other questions? Okay. All right. Thank you all for spending an hour of your valuable lunch with me. I'm sorry I'm ending this on a slide that has tax the rich, but it's it's why we get clients out the door, right? Is they see these little memes and they freak out because they don't consider themselves rich. They consider themselves overtaxed in general. And we could have a political debate about that, but that's beyond the scope of my presentation.
Okay. Hey, thank you very much, Peter. We got through all the questions, I think. So everybody, thank you very much. And maybe we might have to have Peter back. I heard a lot of mentioning of other programs and other additional things. So we'll get with Jay and see what we can come up with. Okay, thanks everybody. Have a great rest of your week.
Yeah, thank you. All right, take care.
Bye-bye.